Hello, everyone, and thank you for joining us. This is Adam Koch, President and Portfolio Manager at Libertas Wealth Management Group in Columbus, Ohio. I apologize for my voice in advance. We'll see if I can't get through this thing today, but I'm going to try and keep it shorter than usual, so that should come, I guess, as a pleasant surprise to most, I assume. But welcome to the second quarter. We're going to go over a lot of different things here about the stock market, the economy, look at a few charts and try to keep things as down to earth as possible. But before we do, let's make sure that everybody's screens are optimized so that you can see this information as best as possible, especially considering the charts can sometimes be a little bit small. So at the bottom of the right-hand corner of the screen here, you'll see a little gear. It kind of has a little HD symbol next to it, maybe. But anyway, you click on that gear, it's going to give you an option for quality. You want it to be the highest quality possible. In this case, on this screen, you see 720p. There might be other options depending on your screen resolution, but pick the highest quality you can. That way you can see these charts and the things we're talking about as best as possible. So without further ado, let's just go ahead and jump right into the material. First and foremost, let's just kind of look back at where we've been. 2015 was a pre-election year, and pre-election years are usually good years for the stock market. But last year, 2015, was the first down year we've seen in a pre-election year since 1939, or since Hitler invaded Poland. So kind of significant there just as a starter. The Santa Claus rally, which is the last 4 trading days of the year and then the first 2 trading days of the new year, is normally up about 2%. And this year, it was actually down 1.4%. So again, not the best result for an indicator in the world here. The first 5 days of 2016 was the worst start for the market in history. January was the worst month for the S&P 500 since 1923. It was also the worst month for the Dow since 1900. We'll talk about some charts here. I'll show you what I'm talking about on the next slide, actually. But the 50-day moving average, which is the average movement of the stock market over 50 days, is still trading below the 150-day moving average. Same goes for the 50 over the 200 days. So basically, the shorter-term trends are still trading below the longer-term trends, which is typically not a good sign. We want to see those improving, and they actually are improving currently, but we need to see a little bit more improvement before significant changes can be made in portfolios. Right now, speaking of making any changes, if we were to make any changes, right now the S&P 500, the market is currently very overbought. And what I mean by that is, if you consider the market to be on a bell curve, right now it's extremely high on its bell curve. And any additions to portfolios into the stock market currently, the probability would be that rubber band has kind of tightened toward the area of being overbought or high, and the probability of that rubber band snapping back to the middle of its trading band, or in other words, snapping back and pulling back to the middle, is pretty high. So if you wanted to add cash right now to the market, to stocks here in the U.S., it probably wouldn't be the best time to do that, just statistically speaking. And then the last thing here, you see the sell in May and go away. If you've never heard that before, it's an old market adage, and basically it refers to the fact that May 1st through November 1st, or May 1st through Halloween, we'll say, is typically the worst 6 months of the year for the stock market. So there's seasonality at play here, and typically we see weaker returns between May 1st and Halloween each year, and the stronger returns start November 1st and then end at the end of April, which is what we're closing in on here right now. If we close in on the stock market, so here's the S&P 500 today. A couple things I want to point out. So I mentioned first and foremost the moving averages. This right here is a 150-day moving average. So it's the average movement of the stock market over 150 days. And then this blue line is the 50 days. So it's the average movement of the market over 50 days. Now you can see here that this shorter term moving average is starting to close in on the longer term one. And again, that is a good sign for the market, but it's one of our only good signs that we're seeing. And we have to be really, really careful not to speculate. Like back here, you can see we had a crossover where the blue line went above the red line. That was a good sign, and it was a good reason why over the course of this time period we got back into the market. Now, since then, we have scaled largely out of the stock market again for the second time in less than 12 months. Which can be frustrating, but you have to follow your rules. You have to kind of like flying a plane. You know, you're flying a plane at night. You don't know which way's up. You got to make sure you're following your instruments. So if this line here is going down and it's trading below the red line, below the 150, that's just one of many, many, many indicators that indicates that there's still trouble on the horizon for the stock market and that we're not yet necessarily in the clear yet here. We're not out of the storm. So we'd like to see the 150, the 50 over the 150 at some point here in the near future in order to give us some more confidence. There's also some ceilings up here, these dotted lines. These are what's called overhead lines of resistance. So these are ceilings over top of the market right now that, in order to really see some material improvement in the market, not only do we want to see these moving averages change, but we're going to want to see the market break north of these metaphorical ceilings above where they sit today. Wanted to point out, I don't usually like using history and kind of overlaying history with what we see today, but this was 2008. Same charts, same moving averages. And what we're seeing here is you see the blue line here, the 50 crosses below the 150, crosses back up, crosses below again, and then it looks like it's going to come right back. So, we saw this happen in 2008, almost halfway through the year. And what ended up happening in the end was the 50-day never crossed above the 150 again, and instead the market obviously tanked over the course of the next several months into its bottom in March of 2009. So, we've seen this movie before. We know how it ended. Not to say that's what's going to happen here with this market going forward, but when you consider all the negativity that we see in the market right now, it's really, really hard, as much as you want to buy back in just because things have been going up for 8 weeks. You have to follow your rules. You have to look at your instruments again. Think of flying that plane again. Otherwise, you might end up getting bit, and that's the last thing you want to do is you get frustrated and try to jump back into the market here just because you don't want to miss out on something. Markets take a really, really long time to crash, and this is a perfect example here. If we go back to the previous slide here, markets peaked out here in July of 2007, starts going down. It's not even until almost a full year later that the majority of that crash, 2007-8, and then obviously bottoming in March of 2009, it wasn't until the latter third, we'll call it, of that crash, things really kind of accelerated to the downside. Another thing I want to point out here, this is a point and figure chart, and what I find really significant is this is a bullish percent chart of all equity funds that you could buy. So when it's in O's, it's going down. When it's in X's, it's going up. At the left and right are percentages here. And what I find significant about this chart in particular is it's a very, very slow moving chart. So you don't see a lot of activity here, or price movement. But what you notice is that in 2001 here, when it crossed below 62%, it was pretty much the beginning of the end. Then it screams back up here, 2003, 4, 5, 6, 7, and then all of a sudden reverses back down again. No big deal here, but again, 2008 crosses below that 62% line, gives us a little head fake, and then it's off to the races again to the downside. So in the last, call it 15, 16 years, this is only the third time that we've seen this very, very slow moving chart cross below 62% again. Now, we could see another head fake. It could resume right back up for the first time in almost 20 years. But the fact of the matter is we need to make sure we're paying attention and taking heed and taking the warning signals from charts like this and not getting careless. We want to make sure we're not being careless here. Okay, now what we're looking at here is how cash or money market ranks versus bonds, domestic stocks, international stocks, currencies, and commodities. So if we look at all 6 asset classes, every investment you could ever buy would be in one of those 6 buckets, or could be in one of those 6 buckets in one way, shape, or form. And what we see here is that since 1997-98, there's only been 2 times in 2000 and 2008 when cash has been ranked number 1 or number 2. And I think, again, for obvious reasons, that's pretty significant when we see that here just in this year, we've seen cash ranked number 2 for the third time since that 2000, and then, of course, the 2007, the beginning of the crash back then. So we need, again, to make sure we're following these warning signals and not just jumping right back into the market or staying in the market for that matter. There needs to be some defense put on the field here. The next slide here I wanted to show you is the number of 10% corrections. So a market correction is defined as a drop from a peak to trough of 10%, call it 10 to 20%. And what we see here is by decade, the number of corrections that we saw from the 20s through the 2010s today. And obviously, what you can probably pick up right away is that recently we're seeing some really low numbers so far. Now, granted, we're only about halfway, just over halfway through the 2010s. So if we kept on pace, maybe this would start to look like the 70s perhaps. But bottom line is, we've only got 4 corrections so far in this decade with just under 4 years to go before the 2010s end. So we could see, again, some volatility pick up here in the very near future, kind of looking a lot like we saw back in August and, of course, in January of this year. And then the last chart I wanted to show you that I thought was very interesting, this came from Northman Trader. What you're looking at first is the S&P 500 price chart going back to 2012. And then the solid line here are corporate earnings. And one of the things that you notice right away toward the end of the chart here is a pretty drastic decoupling between corporate earnings and the price of the S&P 500. So the earnings that we're looking at here that have dropped about 15% off the high back in early 2015, these are the earnings of the companies within the S&P 500. And the question, becomes, when you consider what's going on with the Fed, with interest rates obviously going up just a quarter point in December, and then the market freaking out in December and January, but you got to start asking yourself, for how long can we see corporate earnings go down? Will we see corporations stop buying back their own stock, which that could hurt the market? And the wild card, I suppose, is will the Fed do anything? We've heard a lot of talk on TV about what the Fed's going to do, and whether it's dropping rates again to 0 from a quarter point, and there's been some talk even about issuing another round of quantitative easing, or in other words, stimulus, like we've seen in the past. So good segue, actually. So let's talk about stimulus just for a second here. So here is at the beginning of this chart is the crash, the market crash from 2007 through 2009. In January of 2009, we have the first round of stimulus, which lasts until March of 2010. Notice the chart and how well the market does right up until March of 2010, or just after April of 2010. Then kind of putzes around a little bit. Then we see QE2, or in other words, their second round of stimulus. Market goes up. It's a very short term periods of stimulus here. And then all of a sudden, what happens? Market goes down. Then third round of stimulus. Now, this wasn't QE, this was Operation Twist, where bonds were being traded in this case. I won't get into the details, but basically we have 2 rounds of Operation Twist. The first one from September of 2011 through June of 2012, and then the second round from June of 2012 through December of 2012. So over that time period, again, we see a general rise in the market, a little kind of pullback at the end of each one of those rounds of stimulus. And then in September, on September 13th of 2012, we have Ben Bernanke's Q Eternity, or QE3, where we started seeing stimulus on a monthly basis with no end planned, and that lasted from September 2012 all the way till October of 2014. Now, since then, we've kind of seen the market putz around again, and we're only talking a 4.8% rough gain, so call it 5% gain since the end of the last stimulus package. So again, going back to what I was saying before, the wild card here is whether or not the Fed will issue another round of stimulus here between now and the election, let's just say. It would not surprise me, even though they're saying that rates are probably going to go up again another quarter point in June, or that they're considering 2 rate increases still. It would not surprise me one bit to not see any further rate increases this year. And if they did do a single rate increase, I would think they'd have to do one in June, because if the market doesn't like it, they need enough time between June and the election to institute another round of stimulus, another round of QE, in order to boost the stock market up, assuming that's what would happen, of course, but they would need that to boost the market up between then and the election in order to ensure that we don't see some sort of big market crash between, call it now or June, and the election in November of this year. So That's kind of the wild card here. This is our chart of defensive preparedness, the 5 main things. Now, there's a whole lot more than this than we follow, but these are the 5 main things that we pay attention to when we're kind of being defensive or considering whether or not we want to be defensive. And, let's just start at the top here. So defensive asset classes giving relative strength or RS buy signals over offensive asset classes. The top asset classes right now, again, are fixed income, and then we have domestic stocks and cash, which are kind of jockeying for the number 2 position. So obviously cash and fixed income are very defensive asset classes. There's no doubt about that. So that would be one penalty flag that's definitely up right now, which again indicates we need to make sure we're being a little bit more defensive than normal. The second one right here, trend charts of major indices turning negative and important levels of support violated. This has happened. The S&P and Dow have both violated support levels or broken their trend multiple times in the last 9 months. So this is something that's currently we're seeing positive trends in the short term, but overall longer term negative trends in the market, at least with a negative bias anyway. Third is narrowing of leadership from individual sectors, and what that basically means is how many sectors are participating in the market in either direction, but obviously up. And what we've recently seen in this last 9 weeks since the February 11th low is a lot of the laggard sectors doing really well, bringing the stock market up. And what I mean by that is, the stuff that did really, really well last year, the year before, and the year before that, stuff like biotechnology, pharmaceuticals, healthcare, has been really, really beat up. Whereas the stuff that's really brought the market up this past 9 weeks has been things that have been horrible the last year and a half or so, which were, energy-related investments, commodity-related investments. So we're talking, oil, we're talking metals like gold, silver, and things of that nature, silver mining stocks, gold mining stocks. So basically, we do see a pretty narrow leadership right now among sectors. Some of the best sectors in the market right now are consumer staples, utilities, which are obviously defensive in nature. Positive trend indicators, so the PT charts, or in other words, the percentage of stocks trading in a positive trend is still below 50%. So again, another penalty flag here. And then lower tops and bullish percents. This is the only one that's not up right now. We've actually seen a higher, in other words, a buy signal on the bullish percent chart. So when we look at all 5 of these penalty flags, what we see here is one positive with lower tops and BP bullish percent charts, or higher highs in the percentage of stocks trading on a higher high. But otherwise, we see pretty much 4 penalty flags up. Short-term markets strengthening, but longer term, still, again, very much a negative bias. And I think it's very important right now to make sure that we're taking a defensive stance. So with that said, let's just kind of wrap things up here briefly. I just want to show you what our portfolios look like today. Right now, our aggressive portfolio has 20% or so of the portfolio invested in domestic stocks, in a few stocks that basically are currently trading on a positive trend and still look very good today. So we haven't stopped out. We haven't trimmed them. This last 20% we still own. We have 35% of that portfolio in fixed income, or in other words, bonds, and then we have 45% of that portfolio in cash. Our moderate growth portfolio, 6% in stocks is all that's left. Again, just one other position that has not stopped out or has not broken down yet. We're just going to hold on to it for the time being until that something changes. You got to always remember, the trend is your friend. So the stock's trading in a positive trend until it's not, and right now it is. So until it's not, we're going to continue holding on to this one, or until something breaks down here. 86% of the portfolio, moderate growth portfolios in fixed income, so bonds, and then again 2% in cash here. Our balanced and conservative portfolios look identical right now. So all of these portfolios, our balanced and conservative portfolios, are invested 98% in bonds and 2% in cash. So not much really to talk about there. Let's just briefly look at bonds. So we can own a bunch of different bonds: high quality corporates, municipal bonds, multi-sector, international bonds, high yield, which have been in the basement lately. You don't want to touch those. Treasury inflation protected securities, so stuff that goes up when inflation goes up, and then floating rate. So these are investments that go up when interest rates go up. We've been focused mostly on high quality corporates, municipal bonds, and some of the multi-sector stuff. We've been looking at focused on some long-term treasuries, intermediate-term treasuries, and things of that nature. But at least that's where the strength is right now. But going forward, our game plan is it's a lot like traffic. I didn't mention this earlier, but that picture you see at the left here. I was driving up to Cleveland last week, and all of a sudden things just stopped on the highway, and it took me probably 30 minutes to go 2 miles. And when you see traffic stopped ahead of you, you don't want to just keep the cruise set on 75 miles an hour and run right into the cars in front of you, of course. You want to turn the cruise off. You want to coast for a second, cover the brake, and slow down. And that's pretty much what we've been doing with our portfolios in terms of the market as it's turned into a traffic jam. We can't really see what's ahead. We can't see whether it's an accident. We can't see whether there's construction. We don't really know why traffic's occurring and why we've slowed down. But the fact of the matter is the seasonally weak months start on May 1st. So sell in May and go away starts May 1st, if not before. And if you're interested in what I mean by that, feel free to email me. If the Fed implements QE, and the market starts to fire up at some point here in the next few months, then obviously we're probably going to want to get back in the market in a material way, but we're going to want to wait for some sort of pullback between now and then to do so. We don't want to buy high. The S&P index, again, currently 97% overbought, so think of that rubber band. It's really stretched out right now, and it's probably going to pull back. So again, whether QE occurs or not, if things materially continue changing in a positive direction for the stock market, then we're going to want to wait for a pullback. Obviously, paying attention to the 50 over the 150, the 50 over the 200, but the 50-day moving average over the 150-day moving average is a little bit faster indicator. Helps us get in a little bit earlier, gives us a little bit more confidence earlier. But otherwise, we're kind of covering the brake pedal right now because short term, the market has gone up again, largely on laggard stocks, laggard sectors. But intermediate and long term, the market still very much has a lot of trouble ahead. We don't know whether it's going to fire up to new highs here, but everything that I'm looking at right now is telling me that we need to play defense. We need to be careful what we own and as it pertains to stock investments, equity investments. So thank you, as always, for watching. If you have any questions at all, feel free to check out our website. Feel free to follow us on Twitter, either at Libertas WM, which is our company page, or me personally. I'm not super active, but I post stuff when I can, just kind of intermittent updates both on Twitter and Facebook, and you can see our Facebook page there as well. Feel free to look us up on the web. You can look us up on MarketWatch. We're a regular on MarketWatch.com in the trading deck, which is not up here on this slide. But if you have any questions, if you'd like to set up an introductory appointment, if you want to have a financial plan done to see whether or not you're on track to retiring when you'd like to have the choice to quit working, if you'd like to have your portfolio reviewed, get a second opinion in your portfolio. Sales at our office is not our style. We're not the kind of people that are going to beat your portfolio up and tell you why you should sell everything you have and buy all our stuff. We just don't work that way. We legally can't even charge commissions because we're a fee-only registered investment advisory firm. So if you have a question, just always remember you don't have to be a client to ask a question, and just know that we're here to help. Whether it's a friend, family members, that's what we're here for. So especially times like these, this is about a whole lot more than just money or who's going to become a client. So thank you again for your time, and we will look forward to talking to you soon.